welcome everyone. We certainly thank you for joining us today. You probably know the topic that's going to be at hand, cash flow and credit. You can see it on the screen. As Carolyn mentioned, I am Brent Hoover. I run the Aiken area SBDC here. I also teach as a business professor / economics. And of course, Jason Rabun from First Citizens Bank will be presenting as well. I'll end up covering the cash flow portion. Jason will cover the credit, and we will take your questions at the end. So as Carolyn mentioned, please feel free to go ahead and type them throughout this lecture, and we will get to them at the conclusion of the presentation. So with that said, let's go ahead and get started, shall we? Naturally, every presentation has a good agenda, so you can see ours. First of all, we will give you more information about who we are at SBDC and what we can offer to you as a potential client. Naturally, then I will be discussing the cash flow portion. I am going to structure this as a twofold approach because I realize everybody's at a different stage of the business life cycle. We're going to cover the pre-venture / startup section. And of course, too, I want to make sure there's plenty of information if you are an existing business, so that way no one's disappointed on that front. Then Jason will take over, giving you more information about First Citizens Bank, what they have to offer, and of course, getting into the credit portion. As I mentioned prior, we will then have a review session. We'll have contact information available and take any of those questions that you have. So that said, who are we at SBDC? Well, we stand for the South Carolina Small Business Development Center. DOT often jokes that we're one of the best kept secrets in South Carolina, so we certainly appreciate that comment. Now, what does that actually mean to you as a small business? Well, we can offer you no cost, confidential counseling services, one-on-one. So we're not a volunteer base. We do actually have to maintain 20 to 30 hours professional development. So we stay very well versed in the business world. We can help you really any stage that you're at. You're at that essentially pre-venture, you don't know what you want to do. You're ready to actually start up the business. You're ready to expand or potentially sell. Any of those components we can certainly assist with. I often joke the only things I really can't help with are the legal and the tax elements, and that is true. But we do have quite a few connections with those professionals so we can get you in the right place, ensuring that you have help in all areas. And that's what I'm mentioning here under the second point, the valuable resources. We end up actually also having a pro bono partnership with the Turner Pageant's law office. It's called the Palmetto Propeller. For essentially one project, they will assist on, from the legal aspect, $2,500 market value, no cost to you as the client. It's a great benefit that we've been doing for, I think, since 2018. Now, in terms of the education and training workshop, you're here. Therefore, you're taking advantage of that. We will continue to do these webinars. COVID has transitioned over us to the Zoom. And for the most part, we see that working out pretty well for the various topics. If there's a specific topic that you would like to potentially see in the future, please let us know. And we're always eager to get feedback from those who attend. Now, in cybersecurity, as you can imagine, has become more prevalent these days than ever. Because of that, we also assist with the CMMC Level 1 initiative. That's the Cyber Maturity Model Certification, the basic cyber hygiene. That model is still in flux. It's coming through the Department of Defense, but understand this, as a small business, you are a soft target. It is easier to hack you than potentially a company that has a fully fledged IT infrastructure. Therefore, what are some of the steps that you can take to prevent that from becoming a reality? Now, are these all our services? No, we have a couple others certainly as well. We have export consultants, we have government contracting assistance, product specialization, etc. But we believe in helping anybody who's engaged in economic development as a small business owner. We want to see that your dreams become a reality. If you're willing to work with us, we're willing to certainly to work with you. The only thing we can't help with also too is the nonprofit angle, okay? But as many times you want to meet with us, we'll be happy to do so. There's no charge on that. So with that said, let's actually talk about the cash flow. So as I mentioned earlier, right, twofold approach. I want to make sure people find enough information if you're in the startup phase or the existing. But let's go ahead and get some rather established principles out of the way. Number one, everybody loves saying, oh, I've got so many assets on your book. Just because you have an asset doesn't mean you're actually generating liquidity, okay? The cash flow angle is far different than the balance sheet. The balance sheet grade shows our assets, liabilities, equity. But what I'm really focused on with a lot of my clients is the actual cash flow. I'm not talking about the statements of cash flows through, say, a GAAP principle, accounting sheet that's necessary, perhaps if your business were to become, publicly traded. No, what I'm really interested in is actually the flow of liquidity, month by month, what's going on with the net cash added, net cash subtracted, how does that affect things such as a working capital buffer? That is what I certainly pay close attention to. And I also, too, I've got this phrase, the end is the beginning, because here's the whole thing. Whether you are a new business or you are an existing business, when we do cash flow management, I need to know where you need to be personally for your business within the time frame that we're evaluating. So if we're talking about as a startup, right? All right, the bank's going to probably need you to do 3 years of pro forma work, doing that forecast out 3 years. Where do you need to be at the end of year 3? If you're an existing business that's not needing a loan, you're just simply wanting to understand how can we become more liquid, I still need to know where you need to be in that case. Now, I'm also not going to just use PowerPoint. I'm going to demo a few things within Excel, and I've also got a PDF showing another one of our cool tools that we will utilize if you decide to become a client and we want to evaluate a set of cash flow. Now, there are some minimum requirements, as you can imagine, that would come through on your way. The first thing I really pay attention to, whether you're startup or existing, this is crucial. It's called a WCB, working capital buffer. Now, how do we actually calculate that? One of the easiest ways, what's going on with your operational expenses? It takes some amount of money to keep your business, essentially the lights on, the operations moving from day to day in 1 month. What's that average look like? I like to take that times 6 because that's showing me that you have sufficient liquid reserves in case a disaster strikes, and therefore you're not potentially going into the world of insolvency. Now, of course, another thing that's good to pay attention to is what's going on with your credit. Now, Jason's going to talk about that, certainly, but I mean, I figured we'd go ahead and have a quick starter point, and that is not only the personal side, but the business. Do you have 680 plus on your FICO score? Now, the business side, it has its own credit scores, which Jason will talk about. One of those is the PAYDEX, and are you 80 or above? This is great because you never know when you may actually need an additional form of debt financing. And therefore, if that's necessary for your cash flow component, well, we want to make sure some of these elements are certainly in place to begin with. And the last point you see here is the angle of collateral. When you're needing a business loan, it is absolutely crucial. I told you, you don't know if debt financing may become a requirement, emergency requirement in the future. Therefore, one of the things I actually suggest is when a business is looking at their cash flow, whether starting out or moving forward, say in year 2, year 3, is to keep essentially a schedule of potential collateral. That could be things from actually cash, getting 100% of your cash collateral value, but it could go down the list of discounted values such as into real estate, machinery, equipment, inventory, the list goes on. But the first point, that still brings us strictly back to the cash flow angle, and that is the working capital buffer. And to reiterate, take your average operational expenses per month, times out by 6, and you've probably just got your good buffer in place. Now, for those that are in the pre-venture / startup phase, there's naturally going to be a process involved. You can see here, maybe you're needing a loan, maybe you're working on your business plan, seeing how the liquidity angle affects you. But I will tell you this, the pro forma comes before all, in my opinion. Now, that's not written in stone, but as a consultant, it's one of those things we have our clients do from the beginning. If the numbers aren't working, well, the rest of it may end up being simply superfluous. Now, let's say you are needing to build pro forma, either for the bank in the beginning to expand your business out, or you're simply just wanting to understand what's going on with forecasting. Fun fact, here's something you probably may notice as a business owner if you're existing. You get caught up in running the business, but you actually may focus less on managing the business for the long-term nature. One of those things is people always assume forecasting is something only necessary for the bank. No, I actually highly encourage it for businesses to continuously do that. Now, there's 2 ways to really get into that angle. I mean, we could use Excel, we could end up using Profit Sense, etc. And I'm going to talk about how some of the ways we end up utilizing that. Well, you saw the working capital buffer, right? I'm always encouraging clients to go 3 years out into the future based on what they're wanting to do with the business. Okay, the good thing about a pro forma, if you're starting off right, at least you know your expenses, right? The revenue kind of brings into the data modeling point where we see, okay, based on all the expenses we have, where do we need to be? And that also shows a point of the debt service coverage ratio. Jason, as a banker, certainly if you were to use his bank for a business loan, they would want to know what's going on with your debt service coverage ratio. Now, that's if you are actually needing a loan. And to give you a reference on that ratio, I'll demo real quickly in Excel later on so you can see. But essentially, whatever that number is, take one out of it, and it's essentially telling you how many months into the future you could pay back without tapping into cash reserves. So it's looking at your immediate cash flow and not so much what's sitting in the bank on reserves. Now, there's another ratio I strongly encourage every business to look at and calculate for themselves, and that's the owner's coverage ratio. In that sense, we treat you as the owner as if you were the bank of your own company, because that's in essence really what you have to do. Even if you don't get a formal lending institution to give you money, you are injecting your own equity, your own cash into the business. And hopefully you generate enough revenue that you're able to take that out and pay yourself. So in essence, in a way, you are the bank. I literally use the exact same formula, which taking the net profit per month divided by the debt repayment. And instead of the debt repayment to the bank, I actually swap that out to what you're paying yourself. So with these ratios, what am I really looking for, especially with the owner's coverage ratio? The ideal thing I'd want a client to be at is a 2.0. Because 2.0 is a one-to-one match, meaning when we're literally doing the pro forma analysis in Excel, the net cash added of the business account, it is growing at the exact dollar amount that your own personal bank account is growing at. If we get above it, even better. This is not something that, of course, that's going to be requirements, say, of underwriting necessarily. But it is something that if you are wanting to maintain cash flow, I think it's absolutely critical to look at. The cool tool we end up utilizing, it's very simplistic, is GoalSeek within Excel. All right, it's not Solver. You're not having to set multiple constraints. It's literally only doing one thing. You're setting a cell to be this exact amount, and you're telling it to change another one to get there. And it'll tell you essentially, like the last slide was, or previous slides, the end is the beginning. All right. With a pro forma, just another fancy term for looking at that forecast moving forward into the future, whether that is for a bank loan or doing it simply to look internally at the liquidity of our business. The reason I had 3 years of break even, that's if you're actually needing that for a lending institution. If you're just doing it for yourself, you can set the time frame. But we're able to look at what is that working capital buffer. If you have any debt, what's going on with our active debt service coverage ratio. Each bank's going to have their own minimum requirements. Some could be 1.2, some could be 1.25, some could be 1.5. And you can actually see within some of the templates I've created how you're actually doing it in real time with said ratio, and also, of course, with the owner's coverage ratio. That can apply to any business. Therefore, I stress it as such. Let's go on to the next slide. Now, if you're in the beginning business, right? So this is talking to those in the pre-venture or the startup phase. One of the golden rules I use of budgeting is to overestimate your costs and you underestimate your sales. Therefore, you have no surprises waiting for you at the end of the race. Okay, you do know definitively what it's going to cost. And this could be true as well if you're looking at doing a new location as an existing business where you're expanding into a new market. Start with the cost. Those are definitive, right? You know it's going to actually take a certain amount of money to have this operation move forward. The reason I actually use the sales as the later option here in my second point, forecasting the sales versus the expenses first. I like the expenses first because I know definitively what it's going to cost. I can get the quotes, the sources, show that to an underwriter or just for our own internal team. But then we can end up using the tools to see, such as GoalSeek, all right, based on these expenses, where do the sales actually need to be in order for us to hit a certain target ratio? Could be the owner's coverage ratio, could be the debt service coverage ratio. That is entirely up to you. Here's one thing I'll go ahead and say it. We're going to talk about it later. I always ask my clients to be able to answer one question, and that is ideally, how much do you need to pay yourself? I find that clients typically have trouble with that answer because they'll say, oh, I don't need to pay myself, for the first year, that doesn't matter. No, I'm like, I do need to know what you intend to make out of this company. Unless it's a hobby, I'm assuming you didn't get in this business other than to perhaps fulfill your dream and be able to pay yourself some form of income. That's one of those critical elements that will play a factor into doing GoalSeek properly, is understanding what do you need out of that business. Doesn't mean you're necessarily going to pay yourself that amount starting into this new project or this new company, but it does give us a good objective to work towards, and therefore the numbers are going to be more accurate. Like I said, I don't like surprises in cash flow management, whether we're starting in the beginning or working our way 10 years down the road. Surprises typically are going to lead to extra cash being paid. Now, this sub-bullet point I've got here on buying a business. So let's say that you are looking to potentially expand a new market, and how you're going to get there is actually purchasing a company. From that perspective of cash flow, you actually have an advantage because you can pull the prior data out of that scenario, right? You can go to the company and say, hey, look, I need to know not only the tax breakdown for the annual income, but I'd like to see what you made in sales per month. Therefore, you get a strong enough sample size, say 36 months, you can go forecast into Excel. I'll go ahead and talk about that briefly as well, because that's one of the tools, whether you are a new business, purchasing one 5 years down in operations, you can actually forecast sales in Excel. It's not an exact science. Number one, you need a strong sample size, 12 months at the minimum. I'd like to see that realistically get about 36. We get larger the sample size, we can actually see further where there are those outliers, right? Because imagine if only you had 2020 data, January sales, February sales, etc. You might imagine and see that that might not be the best sample size around. Why? Because that was a very unique year. Okay, so if we get enough years put together, the program can actually see, okay, where are some of the common elements of what's known as seasonality? Now, that said, speaking of seasonality, and I'll even show you this later on, I highly recommend you do manual seasonality versus automatic. Because a lot of times if you do automatic seasonality, you just pump in the data and say, all right, I need to forecast 2 years into the future. Show me what might happen to my cash flow in that perspective. It's probably going to paint a lovely picture where it just perfectly goes larger and larger. That line never deviates from its trajectory. Well, that's not reality, and we know it. So what we can end up doing is manually putting in the points of seasonality throughout the year. Maybe there are 4 times where it fluctuates across that 12-month spectrum. When you start to manually adjust that up the confidence interval, we then start to see a more realistic picture about what might be going on with your sales. That's just one tool available. Now, I told you Excel is not the only tool. So another one that we certainly like working with is QuickBooks. If you ask me how many programs do I use to properly analyze the cash flow of business, I like to do QuickBooks, Excel, and ProfitSense. You may or may not be using QuickBooks, but I can tell you, we will use Excel to some component, and ProfitSense is an amazing tool which we have access to, and that allows us to go a step further, okay? But one of the first things, let's say you're a new business, right? You've gotten around maybe for a year, you have a sample size in place. Now you want to start to do some data modeling. QuickBooks is amazing for keeping track of records. They can do some analytical insights as well, but if you want true data modeling, we're going to need to turn to good old Microsoft Excel for that matter. One of the first things I always ask a client to do is, all right, you want me to analyze what's going on with your cash flow, go export the P&L detail, the profit and loss detail, okay? Now that's to go further in depth and to say, it'll actually tell me that out of advertising, right? Here's how much you paid to company A, paid to company B, company C. That's getting as granular as possible. Now, if you don't want to go to that step, just give me the monthly P&L breakdown. In that scenario, we can export it to Excel format. I can bring it into my templates I've created, and therefore I can start to run the data modeling. Say if we want to hit the debt service coverage ratio 3.0, increase it further, an owner's coverage ratio 2.5. The list goes on. Whatever you're seeking at the end, we'll be able to calculate, and therefore the rest of it gets into the logistics. Well, how do we actually make that possible? Now, ProfitSense. So ProfitSense is a different tool, okay? You will have to pay for it if you decide to utilize it. Thankfully, we have subscription. It's one of the benefits that we can offer as a value proposition to our clients. I always want to run through it. This is something new I've started taking advantage of. One of my colleagues said, you really need to get involved with ProfitSense. In the beginning, I was like, I don't know. And then I started taking advantage of it, and I realized I'd seen the light of day. Therefore, I use it now to properly benchmark businesses. Now, what ProfitSense will do is we don't have the monthly profit and loss breakdown. Essentially, one of the easiest ways to actually operate off of it is with the tax return, especially if you're an S Corp, because you'll have a balance sheet associated on that tax return. Now, that's looking at it from the annual basis. I still use Excel to do month by month. I'm always making sure, do you have enough of a buffer here? Because everybody's always assuming, hey, I've got all these assets, right? But I told you cash, 1 month goes terrible, a tax return will not show that necessarily. But when we see the month-by-month breakdown, it will certainly show how close you came to insolvency. But Profit Sense, what it's going to actually do, as I mentioned, is benchmark. And it'll benchmark the various categories. And I'll pull up a sample report I exported out of Profit Sense to show you this. What it allows is, say you have advertising, right? You got cost of goods sold. The list goes on. It'll actually take that specific line item and actually reference it into total sales. So total sales as of itself is always 100%. But advertising, how much of that of your total sales and percentage amount is it? Is it 15%? Is it 5%? And what it's going to do is allow us to see what does the typical company do in relation to their total sales for this specific line item. And so we can see where there's an under or an over deviation from that mean. Now, that doesn't necessarily mean your business is doing something wrong, but we do need to investigate further on that angle. And so it allows us to see, well, if you got an over buffer, maybe you could be spending extra cash on this other angle versus this one subset of the budget. It's a great tool, not to mention it can also forecast sales. You're able to do the what if analysis of Excel just in a different format here. So between the two, we can actually give you a larger sample size than just one program saying, here's what we think is going to go on with the cash flow of your business, given these prior sales. So great tools to utilize, but notice it's not just one. We use a mixture of all three. The third point, I cannot stress this enough, whether you're dealing, if you want to get to the most granular level of cash flow analysis, it is utilizing this rule. The marginal benefit is greater than or equal to the marginal cost. Every line item of your business has that cost associated with it, hence the marginal cost. But what is that one specific line item generating in terms of benefit? So we're looking at this from the expenses, because they always say you have to spend money to make money. Well, is it actually earning its return on its investment? In this case, on the most granular level possible. We do this with advertising. You're spending, say, $200 a month on advertising. I want to actually look at the analytics associated with that $200 and say, is it actually earning 201? I mean, if you're starting off with advertising, there's probably going to be a buffer period that your company that you're working with or doing individually will say, hey, it's going to take some time. I'm going to give it 6 months, right? But after that 6-month period, I'm going to turn to the data analytics and look at it and evaluate whether or not that $200 is actually earning, say, 201 or more, because that's one of the most granular level possibles for cash flow. But that detail certainly has the value nonetheless, because you're able to look at it from a micro perspective. Are we spending our money in the right way? Now, there are other angles outside of that that we should also explore here. I always want to pay attention to, because at the end of the day, cash flow is about the money going in and the money going out. And not everybody pays you on time. And on the inverse, you don't always pay other people on time. Hence why we are always looking at it from the aging accounts receivable and the aging accounts payable. One's our asset, one's going on with our liability. Now, if we're using a program like QuickBooks, we're able to actually give the aging accounts receivable and aging accounts payable in terms of detail, right? So if we're staying within that 30-day period, great. But still, we want to get paid quicker. That's one of the benefits about QuickBooks. It'll even show you on your dashboard with the metric analysis. Hey, this is who actually owes you the money, right? This is who you owe money to, and how long has it been sitting out there, okay? From the accounts receivable, we want to see ways to actually expedite that receivable element, because understand that receivable may be an asset on the balance sheet, but it is not cash as of yet. We want to convert it into its most liquid form, get it right there to the cash and the cash equivalent. Now with the accounts payable, right? I know it's not exactly rocket science, but I ask a client, I'm like, all right, let's look at the aging accounts payable and see. We're like, well, you know, if we have money going out, right, that's bad. It hurts the cash flow. I'm like, yeah, that's true in the most essence of form, but at the same time, as we'll see later, you want to have good supplier relationships. We do need to see, okay, what's going on with the timing of the bills. Generally, I like to look at them in a mixture, right? Because they are linked in essence. They're both things that are accounts out there. They are aging. Therefore, may not seem like rocket science, but I'm certainly going to evaluate what's going on with the business for that angle. What are some of the problems that end up arising? I think they did a poll prior to COVID that said 58%, 58 or 59% of all companies suffered some form of liquidity issues. That was prior to COVID. I can only imagine what that statistic now looks like. So with a business that is suffering from that cash flow program, not the being asset broke, right? But cash broke or close enough to it, what can you end up actually doing to fix that? Well, number one, I mean, that pulled out that marginal benefit greater than the marginal cost, right? Actually looking at the most granular level possible. Is it earning its most bang for its buck? One of the first things too we'll look at, it's not always ideal. Hopefully we strategize better than that, but sometimes, maybe you come to my office and we are stuck with the situation at hand, so we got to work with what we have. Let's look at the discretionary costs. Now, be careful about discretionary costs. So if you look at it from the textbook perspective, right, maybe things that are non-essential. I think it's odd because sometimes you'll see advertising put into that category, and that could or could not be true. Because I told you, right, if the data analytics show if we're spending $500 on advertising, like, well, that's a discretionary cost, let's get rid of it. I'm going to look at the analytics and it shows, hey, that $500 campaign is actually earning $1,000 in revenue. That is not discretionary. That's a lifeblood of your business, right? But that could be, can we get by without doing some maintenance on this one piece of equipment? It's certainly going to work fine. We don't see it breaking anytime. What about this training element? Can we actually hold off for a little bit? Some of that even involves giving donations to, say, local nonprofits. You want to make sure your company's name out there. And that one can sometimes hit a sour note on some scenarios. But I often tell that, I'm like, look, on those angles, you may have to go 3 months without making that one donation if you like, but you'd rather go that 3 donations, get this fixed and make up for it later than say give money now and then your company's out of business. So you'll really look at what is truly essential to the operation of the business. Those that are not technically minimized discretionary costs. Now notice I didn't say completely eliminate them, but you can see what you can get by for the time being. One of the things people that come to me, they're like, oh yeah, I've got cash flow problems. I'm like, okay. And they're like, I need to get equipment. I'm like, all right. They said, I'm going to go buy used. Well, that could be a double-edged sword. Sometimes you can get a really great deal on something that was like new, but it's used. Therefore, you got a discount on it and it works pretty well. But some of those times I actually have to help people analyze what's going to go on with the expected maintenance of equipment in that case, because you may think you're getting a deal in the beginning, it's going to help your cash flow analysis from this perspective, but then suddenly it starts breaking every month. Therefore, that's a reoccurring cost and you're back where you started. So like many things in life, you want to delve into the research a little bit more. A third point on here is the balance sheet review. And yes, this will actually get into what we do with the benchmarking and profit sense. So of course, we're going to run the current ratio, we're going to run quick cash ratio, the asset turnover, you name it. All those standard financial ratios, but it does require us to pull out a balance sheet. So one of the reasons I actually encourage people to get QuickBooks is because you will have a real-time balance sheet put in place. If you're operating simply off of Excel, you may or may not have that luxury. And so calculating some of these ratios becomes a little bit more difficult. And of course, a ratio is just a number. A number needs a context around it. So therefore, we look at it based on your industry's perspective, how far you deviate from that typical mean. And like I said, just because you deviate does not necessarily mean something's going wrong. There could be unique circumstances in your business, but it is worth investigating nonetheless. And another great thing that is going to be available either through Profit Sense or in real time with QuickBooks is the Performance Center. We can look at the percent change, right? So we can see that from something as simple as sales down to other aspects such as advertising. And also too, we can do that on the select ratios. So we can see how the current ratio has changed for the business. We can see how the inventory turnover has changed over a 3-year period, et cetera. It's all about really what you want to track. And so as you can imagine, we got a plethora of information that I've been talking about so far today. That's why when generally as a client, if you were to come to my office and say, hey, I want to do cash flow analysis, we're probably going to spend the first 30 minutes just getting a structure as exactly what you want to look at. What are the key areas? Because I know from my own opinion, what typically the average business is going to look at. But I mean, at the end of the day, the business, the buck stops with you. What do you want me to help you with? So I like to get that structure first. That way, you're not essentially grabbing at random things in the dark, as the proverb says, because that way we can evaluate clearly what is crucial to your business. You got a lot of information at hand. How you actually analyze that information is what separates us from data overload into actually the knowledge base. Now, some other food for thought before I get into actually demoing some of the programs and such. Well, the overbuying element. As you can imagine, the supply chain is a very interesting situation these days. So one of the things our clients were always discussing about is evaluating what's going on with the inventory in terms of QuickBooks, but two, maybe we need to up some of your buffers. I mean, in essence, that's what safety stock is in inventory. It's your working buffer. Except for instead of cash, it's dealing with inventory, right? That's the typical equation you'll see right here for looking at the safety stock levels, right? So you're looking at the maximum use, right? Daily use of it with the lead time, subtracting out the average. Now, as you can imagine, that maximum's been increasing. This is one of those things, while it's not necessarily so much a direct cash flow element, we still sometimes will pay attention to it if the client wants us to, and I do encourage that, because making sure that that inventory you're earning, actually purchasing is earning its buck, right? It's being turned over in that case. But we can do real-time moving averages within Excel and see, okay, how is that maximum amount changing, right, from the time necessary? Some businesses right now have been taking their initial safety stock level and upping it, say, a month or two out. It's going to depend at the discretion of the business, the type of relationship you have suppliers, how many suppliers you could go out. Like I said, this is not an inventory discussion directly, but it does impact cash flow nonetheless. Because yes, if you up your safety stock level, essentially that buffer, that is going to be more cash going out of your business, but you do need to evaluate that with the short term versus the long term. Speaking of that short term versus long term dilemma, one of those elements I certainly stress, once again, not rocket science, is building strong and positive supplier relationships, right? So clearly you're needing some of your raw materials, unless you're 100% service-based business, from another business, right? You may actually have an outstanding accounts payable with that company. Sometimes you'll hear people say, oh yeah, you stretch that cash payment out as maximum, right, as possible. And then sometimes you go to that nth degree. Well, people, they do remember that, okay? If you're paying too quickly on that case, that may be detrimental as well, but finding a nice balance between that. They know you respect them. You're not trying to stretch that out as much as possible. If something horrible happens, they may actually have more leniency with you than they would otherwise. And I cannot stress this once again enough, the contingency cash. I told you 6 months working capital buffer, it's great. Some businesses, they don't really want to operate unless they have enough cash for 3 years without making a penny. That is entirely at your call. I cannot make that for you, but you can see what's going on within your industry and your unique circumstances of the cash game. Now, before we move on to the credit discussion, clearly I wanted to show you some of the things I've been talking about. So I will pull out of that and go into Excel briefly. If we're dealing, whether it's a new business, existing, doesn't matter. This template is what we're going to start with. We'll build it out as much as possible. But I told you there's a simple tool called Goal Seek that we can end up utilizing for this component. So I was trying to get access to that tab. So in the data tab under what if analysis, this most simplest thing possible is Goal Seek. We're going to tell it to set a cell to a certain value. We're going to change the other. So that could be for quite a few things. All right, I'm just going to throw in some random expense here for 20 bucks. I'll put 30 here. You'll actually list out all your expenses, of course, as well. And we're going to add in a quick debt repayment. Let's say we had a $2,000 loan. That's very small, but hey, it'll work for the illustration of the logic of Excel nonetheless. So what I'm going to do here, we could do it for several things. Like I clearly got a negative debt service coverage ratio, right? It's not going to make someone like Jason very happy. But if, say, we were needing to do this pro forma for the bank's perspective, looking at the cash flow moving forward in 3 years, maybe we set it to 1.5. And then we could say, let's change the cells. And then when I do that, it's automatically going to determine what we need exactly to hit a 1.5. Now, that was just with a very simplistic scenario, right, of rent or lease and travel. But I told you earlier in the discussion, what do you need to make out of this business for yourself, right? And so maybe we want to factor that into this scenario. Okay, maybe we want to actually have $3,000 per month. That's necessary. Now, if you'll notice here, my debt service coverage ratio, starting off, just has the net profit divided by the debt repayment. Now, we could actually take that to a different angle. So we could include the owner's withdrawal into that and that would affect the ratio even further. Essentially, we would be bringing in a lot more money for that capacity. But, if that's really up to the bank's discussion and more of a different topic at hand, but once again, it's still dealing with cash flow. Now, the owner's coverage ratio I put into my template as well. This one I certainly like. Okay, so I'm going to set a cell to a certain amount. In this case, I've got D46. So I'm working with the owner's coverage ratio. I told you, you want to be at 2.0 if possible, because it's a 1-to-1 match. Your business account is growing by the same as your personal account. I'm still going to say, go change the cells for me. Now we got a lot more that's required to hit a 2.0. See, I've got exactly 2.00, pay myself $3,000. Essentially, we would need to be making about $6,050 for 1 month. But if you'll notice too, in this case, right, it's not exactly at that point because we haven't put in some other scenarios and debt repayments pulling out, but we're getting close to that 1-to-1 match of what we need. And so it's a really good tool to feature in that capacity. Now, this is a template I'd be happy to share. If you decide to become a client, I give it to all my clients out there. We can do with all the forms of data modeling that we need. And so I mentioned, like with QuickBooks, we would export your P&L, hopefully a monthly breakdown, maybe it's a detailed, and I'll actually put it into another ledger template that I've created. So it automatically produces out a real-time working cash flow. Or if you want to save some time, I can just dump it straight into here. I will have to adjust these categories, obviously. This is based on the standard Schedule C classifications for an LLC. But regardless of what other route it's going to take, we can still do the data modeling nonetheless. If for some reason we needed to go a little further out, we could end up going to the solver. Okay, because with cash flow, GoalSeek most of the time is going to get us there. But essentially what GoalSeek is doing is just one constraint, and you're setting a value of. Sometimes we want to see how could we maximize the sales in that case. How could we minimize one other cost? Now, one of those things, if you don't have much proficiency in Excel, be careful of messing around with Solver from the get-go. Actually really look at what you want to do from constraints. I've only had to do that one time with cash flow analysis. But that's Excel essentially with one demo detail. Now, what we also have up here is a fake company that I exported out of ProfitSense. So the CC Cafe ProfitSense won't actually allow you to list the true identity of your company. What you end up doing is you put several numbers, could be abbreviations, could be years. I mean, this is not actually a real company. It's built in as their standard. And what we'll do is based on the information, it'll give us a narrative report as one of the examples, and it'll score it based on liquidity, profitability, sales, borrowing, and assets. Now, you do have to input a balance sheet for most of this to work. Otherwise, you may only get like one of them correct, being profitability. I guess profitability and sales will probably be correct. And it'll grade you based on that with your industry. It'll show how that changes up over the years. But what I'm really interested in too, so this is dealing with 2 years, right? And it looks like nothing in terms of the balance sheets. The balance sheet's blank. But this is that benchmarking I was talking about. And so what we'll be able to do is see how it changes. So this is the most current year in the template example, 2017. And then what it's doing is pulling essentially your NAICS code, your industry classification, and saying, all right, in terms of the percentage of sales, right? So 100 sales are always going to be 100% because it's sales divided by sales, right? But then you want to see, well, what's the cost of goods relation to sales? As you can see, for last year in this example, 32%. The industry is at 41%. So in that case, you're essentially 9% under. Now, in that scenario, that's probably a good thing, okay? But we do need to evaluate further. Just because the number looks good on paper, we want to see, all right, well, maybe there are some issues with the quality of the product that you're doing. Therefore, it might have a long-term impact on it. But from just an initial glance, right, it is 9% under. That's good. As you can see, the gross profit, which is just your sales minus your cost of goods sold in that capacity, we're over the industry average by those 9 points, as you can imagine. Then let's turn to something that is a little over, like rent. Rent's 4% over. That may be due to the area. And that's why with ProfitSense, a lot of times I want to do a different filter to actually further analyze your cash flow. I'll say, all right, let's try to go to state specific. Sometimes that is too granular and we have to go out to the Southeast. But I also like to look at it from the perspective of how much is this company making? Like it'll give you a medium range. So like the basic option, right, is 0 to 1 million, and you go beyond that. And so maybe that is the area that's covering it. You know, advertising is like 1%. That would be something if you were spending like, say, 2016, you know, 4% over the average. Well, why is that? I mean, I would want to look and see, well, what do the analytics say? Is that advertising earning its bang for its buck? Great. But if it's not, clearly we might have an issue. You'll see some blanks here. That's because this data was maybe too granular for these categories like office, car, and truck. But I can see that operating expenses are massively over the industry average of a relation to sales here. But it does make up for it in this sense, because apparently, you know, they weren't 0%, meaning most businesses were breaking even on average, and they're at a 12% profit from the operational aspect. This will, of course, when we take out, you know, other items, shoots down to a 9%, you know, it's losing on average for this industry. So that's positive. So we do have to look at it from year to year. And we can do the same thing with the balance sheet as well. Problem is, you know, we don't actually have that information at hand. And you, a lot of times what you can do at the bottom of it, of course, is actually scale out. You know, they even do standardization. So standardization of the data, Z-score essentially tells you how many standard deviations you are away from the mean from that perspective. But this sample company didn't have that data. So as you can imagine, we have quite a few tools at hand that we can utilize for cash flow management, but the more access to the information, the better. So it really depends on what do you need for your company. So if you come to me, we want to set out a structure involved. You know, if you're operating under QuickBooks, great, I'll export as much as possible out of there, start to really give you some analytical insight as to what's going on with your company. But I do love data modeling for this. So I enjoy doing it for bank loans. I enjoy doing it for existing businesses that just want to see, all right, I would like to get to this point. Maybe it's a sales objective. Maybe it's you paying yourself more money. Maybe it's minimizing this aspect of the cost. All these things we can do, whether it's Excel, QuickBooks, or Proforma. So with that said, Jason, I will turn it over to you. I apologize. I really looked at the time quickly and I was a little over. Let me reshare my screen here.
All good. Thank you, Brent. It's Profit Sense is a fantastic company. I haven't had a ton of experience playing in it, but your review of what they give and can provide clients is critical to long-term success, but also potentially maneuvering and pivoting in similar pandemics that we've experienced as of recent. So as the client environment changes for your business, and things are getting tighter, utilizing those tools that you guys have is key to success long term for your business. I would encourage anyone listening to reach out to Brent or to your local SBDC and get involved in those ways, because they can be vital to long term growth and success of your business. But again, I'm Jason Rabun. I'm a market executive for the greater Aiken market for First Citizens Bank. My primary background over the last 15 years of banking has been in the business and commercial lending role throughout multiple different financial institutions, but I've been with First Citizens for almost 8.5 years now, and run both the retail and business side of our market for Aiken, and strictly just do business and commercial lending. But with that, I want to give you a little bit of background of myself and what I do for the bank, and then a little background to the bank, and then quickly jump into understanding your credit for personal and business reasons. So I graduated from the University of South Carolina with the BA in the business school. Was quickly jump into banking and quickly maneuver my way up within the bank. Left that bank shortly after about 6 years, and then have been with First Citizens Bank ever since. So have been blessed to have a successful career in banking, but I truly, I tell people this on a daily basis. My wife probably hates me for saying it, but small businesses and businesses of really any size that's in our local community is the true backbone of our economy. Yes, the big corporations out there that we all know, the Apples, the Amazons, et cetera, yet they are very, very vital to our economy as well. However, the guys and gals that are putting on their shirts and their tool bags on a daily basis and employing small employees to do their work is just the true key and true success of our American economy. So I commend you for taking the risk and wish you nothing but success as you continue to grow your businesses. And if I can do anything to help, please let me know. As you may or may not know, First Citizens Bank is one of the largest family-controlled banks in this country. We were founded in 1898 in a small town outside of Raleigh, North Carolina, and started out in the agricultural lending area. Our primary focus back then was in tobacco farming, and so that's kind of how we started. The Holding family started that bank and maintained control of First Citizens Bank as we know it today. Just recently, we went through an acquisition of another financial institution that had a larger asset size. However, they were a commercial bank that was strictly focused on online capability lending products. And so we acquired them in late 2020 and just completed that merger. And so they now have fallen within the First Citizens Bank hierarchy. And so with that, we've become and almost $10 billion bank. So we are a very big bank from an asset stance. However, we still are controlled by the Holding family. And so we consider ourselves the biggest bank out there that has the family community aspect that I think we all truly have come to know and love and appreciate. Because if you're not involved in the community that you live in and work in, then unfortunately those types of industries just don't survive. And so with that, we're in 22 states. We have over 10,000 associates and 600 brick and mortar branches scattered throughout primarily the Southeast and Florida and et cetera. We do pick back up in Texas and California on the West Coast and pretty much wrap the rest of the country from California all the way over to Wisconsin. So that's kind of our primary zones. However, South Carolina, North Carolina, and Georgia are our predominantly largest sectors from our brick and mortar and associate-based bankers. So I'm born and raised in Aiken, have 2 kids and a wife, and have been involved in many different business ventures and angel investment groups locally. And so I commend Brent for all he does. He's a fantastic associate to work with from helping clients get to the banking and funding rounds that they need to start their businesses or potentially grow their business. But today we're here to talk about understanding your credit from a personal and from a business aspect, and what we look at from a bank and why we look at these types of things is critical to understanding it. So Brent, if we can jump into the next slide, we'll kind of get going. So what is your credit report? So your credit report, obviously, I'm not going to read through these slides. I think we're all adults and can read for the most part. I do want to highlight some of the main points. But so the credit report is a summary of how you handle your credit accounts. And so they're used by potential lenders and creditors to help them decide, however, and whether they're going to offer their credit and to what terms that they're going to offer that at. The main thing that if you can take anything from this portion of the presentation is understanding it is important and vitally important to check your credit reports regularly to ensure that information is accurate and complete. There are 3 major credit bureaus in the United States, as we know: Equifax, TransUnion, and Experian. And these are the 3 that we talk about and use on a day-to-day basis. And most, if not all, of your financial institutions out there are using one or all 3 of these credit reports. And so sometimes they may use a blended score. Sometimes they may just use 2 of them. Sometimes they do a tri-merge of all 3. And so First Citizens Bank, I can accurately tell you that we use Equifax for personal and Experian for a blended personal and business score. And so those are the ones that we use primarily, and those are probably the larger of the 3. So you will hear a potential Dun & Bradstreet's and the Paydex that Brent mentioned earlier. That is one that is certainly becoming more and more regular on the business side as well. And so it's something I think most financial institutions have moved to or will move to in the near future. So Brent, if we go to the next slide. So what makes up your credit, and what makes up your credit score? So your first major criteria in that is your payment history. So making your payments on time is critical. Late payments are the biggest impact to your score that you can have. Never skip a payment, and just pay them on time. Obviously, as the U.S. Postal Service has experienced there many of delays over the last few years, it's critical to make sure that those payments are more effectively streamlined in today's world. Because if received late and it's past that certain day window, that credit company may have some ability to impact your credit score by reporting that late payment. So to avoid that, streamline it as much as possible, pay them on time, and that will keep your score for the most part intact. The amount that you owe is another big factor. So between your payment history and the amount that you owe, that makes up 65% of your credit score today. And so keeping what you owe under 30% of your limit. So if you have a $10,000 credit card, keeping that below that 30% limit is critical. And even though that you may be paying it off in full monthly, it depends on, as a bank, when we pull your credit, what's been reported. It may be something different than what you actually may have already paid. They don't necessarily have to update that payment within that 24-hour time frame. So if we pull it the day before you made the full payment on your credit card, it may still show an outstanding balance of $7,000. So we're going to take that into an account. Obviously, we're going to stress it back on the full amount that's potentially out there, but it certainly can impact you from your actual credit score. The others, your new accounts, your length of history, and types of credit are the other three factors that make up that remaining 35% of your credit score. Having too many accounts, having too many inquiries, and then your length of history and types of credit are certainly impacts your credit score as well. So making sure that if you're out there shopping for a new car, that you're being very vocal and clear that you don't want them running your credit score until you're ready to make the transaction. They may pull your credit 4 or 5 times before you decide on which car that you want to purchase, just because it may be a different sales agent, you may be at different lots, or et cetera. And so, and then obviously from a length of history, I've told many clients over the years that if you have a high school or college age kid that's driving around to and from school or to and from work, is certainly living underneath your means, but at the same time has the ability to potentially purchase gas or food and so forth. It may be beneficial to look at getting them a credit card to establish them some type of credit. Obviously, you may need to be on that to get them started, but it's a big factor in helping our kids in today's world understanding how to balance a checkbook for one, but more importantly, getting them some credit out there so that if when they go to purchase their own car or own house, they have the ability to make that happen. Because if you don't have a credit score, it's very hard to get credit established. And then types of credit, obviously you have mortgages, student loans, credit cards, et cetera. So having a multitude of those could potentially boost your credit score, but that's a small percentage of your credit score. The two biggest factors being the payment history and amount owed. So we'll go to the next slide. So what's considered good credit? Obviously, today's world, anything above 680 is considered good. Obviously, the bank has a standard as well of 680. We can get down a little lower if we have some mitigating factors to help alleviate that. But 680 is kind of that threshold we look at from a credit score. It does range from 300 to 850. In 15 plus years of banking, I've never seen one in the 300s, and knock on wood, I hope I never do. However, I have seen many of in the 400 range, and so it's key to make sure that you're maintaining a higher credit score of that range of 850 to lower the risk to the potential lender that you're using. And so the following items can affect your score. We put these out there just to make sure that you're aware. So obviously, the number of times that you're having your credit inquired on is going to be out there. It's going to be reporting to the credit bureau for the next 2 years. So if you're shopping this weekend, you're purchasing a car or boat to enjoy this summer, the next 2 years, those inquiries are all going to be reported to those bureaus. Late payments is out there for 7 years, collection payments, again, 7 years, and then bankruptcy up to 10 years. I've seen bankruptcy stay on much longer than 10 years, and I've seen bankruptcy stay on much less than 10 years. However, the standard average is certainly 10 years. And so if you go through that experience, I would highly suggest that you work with not only a financial advisor or institution, but a legal advisor in some regards of getting that rectified. So those are some of the items that can affect your score. And we'll jump into the next slide. So this kind of goes into a little more deeper dive of what's considered good credit. So you have the kind of the ranges from less than 580. Pretty much, I would say a standard for most financial institutions is going to be above that 580, if not a little higher, of being somewhat of a factor of being denied for credit. So making sure that you have a good personal credit score out there before you even go to a financial institution to start a banking relationship and for potential lending opportunity. Make sure that your credit score is above 580 is going to be paramount. Try to land in that area from 680 to 670 to 739. That's considered the average score, slightly above the average U.S. consumer, and most lenders consider this a good score. And then as you go up from 740 to 799, it's considered very good. 800 plus being exceptional. I recently saw 849 for a client that I was working with. Have never seen that one that close to being perfect, but they certainly are out there, and it just goes to show you what paying your bills on time can do for you. And so it actually was a $100,000 unsecured line of credit for HVAC industry, and so they were automatically approved. And we didn't even go through a cash flow analysis, Brent, which is kind of remarkable. We automatically approved it just based on his personal credit score. So those are the advantages that you can see with a perfect credit score. It's quick approval for a lending product that we can offer. So we'll jump into the next slide. So the difference between your personal and business credit scores is as you would imagine, are somewhat different. And so as you have a personal credit score, that range being 300 to 850, you also have a business credit score that ranges from 0 to 100, 0 being a very high risk. Essentially, a lot of clients that we see on a day-to-day basis may have somewhere between 0 and 10 just because they've never established or needed to establish a business credit score or had one pulled against them. So that certainly is a factor. 100 being a lower risk for a lender. So as you move up in that scale, that 80 plus range, as Brent mentioned earlier in the PAYDEX FICO score slide, is kind of the average that we look for from that standpoint. So what's considered, what items are considered when calculating a business credit score? And so obviously, as Brent relied on, the credit obligation factor from of how we get to those types of things are going to be critical. I think we may have went too far just quickly. Yeah, so from supplying obligations to supplier and lenders, your legal filings from UCCs, et cetera, your actual trade payment experience is submitted by payees. So payees are submitting those types of things to PAYDEX and Dun & Bradstreet nowadays. Your public record information, your collections and company background and comparative data that we talk about several times throughout the last slide, presentation with Brent, your Nexus code and so forth. Those are industry compiled data points. And so those types of things are going to affect your credit score as well. So higher risk industry is going to be a higher risk potential for a lower score. But in all cases, it really goes back to your obligation from your suppliers and lenders of what's going to be the main factor on that. So next slide. As we jumped into just briefly, you have 140 variables out there. So the factors that affect your business credit score vary greatly. They shift in the score to include derogatory public records, your UCCs, your judgments that are filed, the status and recency, frequency, and dollar amounts of applicable liens, judgments, and bankruptcies, your trade experiences, your balances outstanding, your credit utilization, how often are you jumping in and out of line of credit and not being reported, in your trends over time. As we mentioned, the SIC code and exit codes are all items that are going to affect it as well. So the size of your business, the geographical location, the industry that you're in, your payments to and from your payees, and then obviously your other items that could be potentially out there that are going to be public record are going to be a factor. And so that's kind of how it makes up that score and the factors that affect it. So we'll jump into the next slide. And so we discussed how long it stays on your personal credit score. So these are your typical industry reporting timelines from on your business credit score. And so that it's important, again, to realize that as you are reviewing your personal credit report, review your business credit report and make sure that the data being reported is accurate and is fair. And so it's going to be vital to you moving forward as you continue to start or grow your business. Your trade data stays out there for 36 months. Your bankruptcies, kind of that similar time frame of the 10 years, is going to be out there for 9 years and 9 months. Very odd, I know, but that's kind of the data on staying on for reporting for businesses on bankruptcies is 9 years and 9 months. Your judgments are out there for 6 years and 9 months. Tax liens, 6 years and 9 months. Your UCC filings, and we do a lot of these, are out there for 5 years. Sometimes they get stuck out there for a little longer than 5 years, just because the entity that's got the UCC out there may not have actually showed that it paid off or removed that UCC from the actual the filing. So make sure that those are done on a regular basis. And then your collections are out there 6 years and 9 months, and bank, government, and leasing data are out there for 36 months. And so those are kind of your data points on how long it stays out there for your business credit report, and making sure, again, that these are updated regularly and you're monitoring them as well. So personal credit versus business credit. So many, as Brent probably sees, we certainly see in the banking industry, it's kind of important to have a personal credit score that's is very good, because to start off, you're going to be a guarantor on that business opportunity and lending opportunity that your business may need. So it's going to come back to both you as a guarantor. So a lot of small business owners, they'll use their personal credit when they're establishing a potential lending product. And so it could potentially put you at risk from the business owner standpoint if the business ever gets in trouble. However, sometimes that may be the mitigating factor of getting the credit done. So making sure your personal credit score, first and foremost, needs to be very good to help get your business started. But using your personal credit to operate and run your business on a day-to-day basis is not something that we would recommend, just first and foremost. So it's vital to use your business credit score to do what it needs to do, your personal credit score for it to do what it needs to do, and then, as you may see fit, utilizing both of them to make the whole picture work. So as sole proprietors, the personal business credit score are closely linked. So it's very important to make sure that you're in tune to taking the steps to protect both of these credit scores on a regular basis. And I would tell you, Brent may have similar opinions of this. I would say some type of quarterly or semi-annual check-in on your credit bureaus are going to be key on a regular basis, whether or not you're in business or not in today's world, unfortunately. So creditors are moving away from just the personal credit score. Again, we've touched on the fact that we as a bank are utilizing both personal and business credit reports, and most financial institutions have either moved to that today or are certainly going to be required to from a regulatory standpoint moving forward. So as you may see fit, it may be beneficial to get some type of business credit score established by either registering for such or reaching out and obtaining some small type of lending product from your financial institution. So next slide. I think this may be the last slide. However, the key point I wanted to make on this is that as we've experienced the COVID-19 pandemic, we're going to emerge from this crisis, and things are going to get back to normal, or what we consider normal. So you, as your business may have experienced obviously some growth over the last 2 years, you certainly are potentially, hopefully, primed and ready to start a new entity or grow the entity that you're currently running. So you may need to seek some type of credit in one form or another. And so as a banker, there's nothing more than I'd love to helping a client take that next step and see the growth potential out there. Even if there is some type of hesitancy on that growth from the business owner standpoint, it's fun to see and fun to watch and fun to be a part of that experience. But the key things to this is to consider it's paying your payments on time. There are many different avenues out there to receive some type of offering of temporary relief and so forth with mortgage companies, credit card companies, auto lenders, banking institutions of some sort, to either defer a payment, make a partial payment, extend a couple of payments, go in interest only. There are many different ways of making this piece kind of come to realization. You avoid the potential impact that you have on your credit score of having a late payment. And this certainly is something I would highly recommend, of having a close contact relationship with those creditors that are out there that you may be experiencing some type of trouble moving forward. Monitoring your credit's the second piece. In today's world, on a daily basis, someone walks into one of my branches within the market in general, but as we all know and hear about on a daily basis, fraud and fraudulent activity of someone's credit, whether or not happen to your loved ones or not. It's only a matter of when. It's not if anymore. It's going to happen to each and every one of us to some degree. Some are much worse than others. As I've seen over my last 15 years, it's only gotten more and more rapid too. So monitoring your credit, making sure that no one's obtained your data, your personal information or business information to establish credit and run up some credit cards that you weren't aware of is key. So another point to make to that is that annualcreditreport.com. And this is not, you hear about the commercials and see all the jingles out there for the credit bureaus. This is a free one that is offered to anybody. Annualcreditreport.com is offering free credit reports now through April of 2022. So if you haven't pulled your credit score, I would encourage you to go out there today, pull your credit report, make sure everything that's reporting is accurate. If not, take the necessary steps to reach out to those creditors or your local financial institution or even potential SBDC score that can help you with getting some additional information to you to reach out to those creditors and make sure that whatever is not being reported correctly is taken care of. So, Brent, I think that is the last slide. Yep. So that's my contact information. Again, I think as Carolyn and Brent mentioned, Brent and I are both here happy to answer any questions. I think Carolyn may moderate it. I think there's been some chats out there, but I'll turn it back over to you, Brent, let you take it from here.
Thanks, Jason. And I apologize about running over a little bit on this. We'll probably, for the future use, we'll probably extend this to 90 minutes to ensure. But for everybody sticking around, Carolyn, do you want me to go ahead and answer some of these questions?
Sure. The first one that we received was in regards to QuickBooks.
Okay.
I have QuickBooks. If QuickBooks does already balance sheets review and cash flow analysis, I still need Excel.
No.
Yes, isn't this a double duty?
Yeah, we're not talking about actually the record keeping on that component. What we're talking about is from the data modeling perspective. Now, certain QuickBooks varieties, if you go up for the higher subscription models, they can do some analytical insight. But if you really want some good old-fashioned data modeling, we're really going to be exporting some of those things from QuickBooks. We're not having to export much. We don't need to export the journal transaction. Really, at the most simplistic form, the monthly P&L breakdown. Take that into Excel and we'll be sufficient on that case. It's really just seeing how the three tools can synergize across the board.
So the other one I see is for you, Jason. Which credit bureau does First Citizen use for personal and business again?
So we use Equifax for our personal credit reporting bureau, and Experian for blended personal and business credits. I will tell you that our mortgage side of the bank, they use a tri-merge, which is really a reporting of all three of those entities. But from this standpoint, this presentation, Equifax on the personal side and Experian on the business.
I think that was it for the questions, Carolyn, if I'm not
Yeah,
mistaken.
that's all I saw.
Great. Well, to everybody, I sincerely appreciate all of you coming and attending so much. Once again, like I said, I apologize about the time overload. That was my fault, mine alone, but I'm glad that we're able to get you this access to information both on the cash flow and the credit side.